Hey everyone, thanks for joining us today on the Budget Decoded. I'm Scott Chapman, the Managing Director of Opteon for Australia and New Zealand, and sitting beside me here is Michael McNulty, the National Director for Residential for Australia. And I'm excited to get into today's episode, Mike, because we're going to be talking a little bit more on a micro basis compared to our first discussion. So Mike, the CGT and negative gearing changes have now passed through Parliament. So there's a little bit more clarity around what that's going to mean, I believe. What do you think it means for investors and lenders?
Well, it means they have a little bit more of a clearer framework about what the actual rules are going to be. And whilst it hasn't been legislated yet, they do have the support of the Greens, and I think most people appreciate it's going to get through. From an investment perspective, from a property market perspective, now that we know those rules, the capital gains tax rules and whatnot, you can now start planning with a lot more certainty. So get yourself educated on what your structure is, what you think is going to happen in the markets, what your exposure is going to be, and make the decisions in an educated way going forward.
Now would be a really good time to lean on industry experts, I believe, with that clarity and start planning, whether it be your property manager, property valuers such as Opteon and so forth.
Well, it means something different to everybody. Your accountant obviously is going to be the big part of that. Let's face it. Now, real estate agents, property managers, obviously valuers, but financial planners and the like. There's going to be a lot of different opinions out there. And one of the things we need to be careful of when you are making decisions is that there are markets within markets within markets. So one size doesn't fit all. I think most people probably appreciate that point, but maybe aren't as in touch at the coalface where they need to be in order to make some of those decisions. They're investment decisions that change lives. So,
good point. So, Michael, we're seeing from our experts on the ground and hearing that the market is moving into a more calmer period with, I guess, less activity from investors and other players in the market. What do you think that means?
Well, it means a few things. When markets are just booming and going really, really strong, there's that fear of missing out factor. So you can buy an average property in an average location and still get really great returns. When markets are a little bit calmer, returns start to be a little less available. So you've got to do a little bit more research. You've got to really understand your product. You've got to manage cash flow risk, vacancy risk, and you want to buy really well. And to do that, you need to understand the dynamics of that market and the property itself. So you need to obviously employ the experts, if you like. And I'm not just talking about valuers here. We're talking about building inspections, speaking to the agents, getting an understanding of the demographics and the like. And from there, making the appropriate decisions for you, especially in how you structure it.
It's a fair point. In a market that is, let's call it a bit calmer, you do have more time to be able to engage those experts and perhaps make a better longer term decision.
Absolutely. And these are long-term decisions. The transaction costs alone are quite significant with stamp duty in Australia. And also these are somewhat illiquid markets. And I say that to, if you're an investor, you've got to give notice, 60 to 90 days notice. And sometimes they've got leases, 12 months leases and so forth. Do you always want to sell it with a tenant in the property? So now we're talking quite a substantial period to get rid of the property or sell the property if you no longer want to hold it. So it is a decision you need to really invest.
It's really thought-provoking because the market can actually change from your decision point to the time of transaction.
Markets change really quickly, as we found out on May the 12th. And when that happens, there's a little bit of a scramble on for sellers who now no longer want to be in the market. Purchases potentially freeze or the demand comes off. Now, that's arguably good for first homeowners, right? So the government would say, hey, we want to give, how do they say it? The first homeowners a real crack or some equivalent. So
they've said a lot of things, but yeah.
And that's fair enough. Their plan is working. But what they won't say is that, hey, we want property prices to crash. And nobody knows, but I don't think they will. There's enough demand out there and supply is not where it needs to be. So
good point. So, Mike, when we look at growth that's been backed by high volume over a period of time, and I think it's also a good opportunity to perhaps explore areas that haven't had strong growth, what are we seeing in regards to the activity around the different markets? You've got any examples?
Got plenty of examples. I'll write them down for you as well. But I'll pick up on something you just said there about that high volume data, because whilst data's not everything, it is important to have good sample sizes, right? And any market that we call shallow in depth, in that you've got maybe a dozen sales in a period of time, there's potentially not a lot of depth to that market. And so you really need to look under the, under the covers there a little bit, because what happens is when there's a lot more data, there's strength behind that to support the number and to support the valuations that you're actually doing.
So can where there's a shallow depth of data in a market, is that usually on a postcode by postcode basis, or does it break into different asset classes in those postcodes?
Oh, both. Absolutely. So yeah, great point. And that goes again to really getting into the data, not just saying, oh, hey, this suburb's gone up by 5% or this suburb's gone down by 5%. It's understanding why, how many properties there are, how many properties transacted, of that nature as well. Right. So yeah, look, a couple of examples that we bought for today. So Kingsgrove in Sydney.
Yeah.
Great example of a suburb that's well sought after. I think it's southwest, maybe 13 kilometres southwest of Sydney.
Yep.
Family suburb, family friendly, good demographics, good amenities and so forth. 4-bedroom, 2-bathroom homes come back a couple of $100,000. So from maybe 3 million down to 2.7.
Since basically the announcement date?
Yeah. Oh, so there's, so over the last 12 to 18 months.
Right.
But what's happened, again, since that time, and this isn't all investors either. These are families that are investing in these things, that all of a sudden the demand has shifted somewhat out of that. So it's harder to sell, longer time on the market. And whilst they're still selling, they're selling at a discount to what they were, as I just said, like that's an 8+% discount in a good suburb that's well sought after. So we've got a number of examples like that we're seeing across especially Melbourne and Sydney.
Oh, so I guess going further from that example, is there the opposite story you might have about an area?
Oh, so WA, SA and regional Queensland or even Brisbane are my favourite examples. They've just, you can, throw a stone and hit something that's gone up 25% in the last 12 months in any of those suburbs.
Yeah.
I liked your example. So there's one in Mackay, very similar to the WA example, where it was a very affordable market 3 or 4 years ago.
Yep.
It was investor driven somewhat, which it has been in the past as you go through these cycles. 450, mid fours, you'd say. You get the 3-bedroom, 4-bedroom sort of 2-bathroom homes, single story. Now they're selling for low eights.
Wow.
Right. Now they got up to the mid eights, and then again, the last few months, that demand has pulled back somewhat. That you're probably in that 800-ish mark. Yeah.
And just to press in further about that market, you've just triggered my thinking that it's a very supply and demand factor that's driving that. So it's not like Mackay has necessarily, using the example, has had a huge increase in supply of property, but a huge amount of demand in regards to the buyers that are going there from outside of the area.
It's definitely demand driven. You're 100% right. Now, part of the demand is access to finance, population growth, migration, immigration, so forth. But importantly, a lack of supply coming onto the market. And I think the government's addressed that issue. I say addressed it, spoken about it a lot.
Yeah.
Haven't been that successful so far, but it's a hard problem to solve.
So in the first episode, we talked a lot about what to expect. Now we're starting to see, I believe, some signals in the market. Have you got some examples?
Got a bunch of signals across the country, and every market, as we both know, has performed differently over the last 5 to 10 years and is performing differently now.
Yeah.
One of the examples, I've got a bunch of them here, but let's talk WA, one of the hottest markets in the country for the last few years. A great example from an investor perspective is Alkimos Beach, or Alkimos, as they call it. Properties 3-4 years ago were around that 450. I'm talking 3-4-bedroom, 2-bathroom, single story, brick veneer, good quality type properties, but there's first homeowners and investors alike up there, young families, and now they're 850.
Wow.
Right now, since the budget, that's pulled back. So think about the growth. That's significant growth over the last 3 to 4 years. Since May the 12th, less demand. So you've taken maybe 30%, 40% of demand out of that market.
Yeah.
Supply is not huge. Now, if supply was to increase significantly or just continue increasing at a faster rate, there might be some impacts there.
It just shows how crucial timing is in a market, and no one can, if you're lucky enough, pick the markets if you like. But when in this occasion where there has been a significant event, such as a tax change legislated across Australia, we are seeing those shifts, and that's a great example.
great example. And there are contradictory ones to that as well. And usually you go to the other side of the country and you might talk about Sydney or Melbourne, where there've been subdued markets or not performing nearly as well as, South Australia, Queensland, and WA. So, there's plenty of examples out there. And even in those markets, there's still strength and there's still softness in different areas. So.
Yeah. My understanding is we're hearing from our experts in the business at a local market level, particularly in places like Southeast Queensland. I think Logan was an example where agents are reporting less demand and less inquiry.
Well, it's a similar story, like I just explained in WA, where the investors have almost immediately from the budget, from May the 12th, come out of the market. They're not looking to buy, or they're reassessing their situation. They're just letting the sort of dust settle, if you like. And Logan's a great example. We've had very strong growth, ongoing demand. It's very affordable. 20 to 25% growth across units and houses from May the 12th. Almost immediately, the number of people inquiring, the amount of demand, that fear of missing out factor, has subdued significantly. Yeah.
And the consumer behavior, because of that fear, if you like, now we're hearing that potentially that sentiment around we're fearful about paying too much in some markets, which is where we're seeing people sort of holding back from activity.
Well, what does it mean for me? And that uncertainty is the big factor where people just freeze. They take it, rather than make a decision, they go, actually, I don't want to commit these big bucks to that type of investment if I don't even know what it means, both from a market perspective, but also personally, financially, and so forth.
Tell you, the other interesting example I came across last week was one of our senior valuers in Cairns was talking about a property they just valued, that had just transacted in the market, that had sold well above the median house price average in regards to the growth. What would you say in regards to that example? Like, what's the takeout for an investor with that?
Well, it's property dependent. It's sub-market dependent. So some properties are still attracting strong demand with cashed up buyers. And it, again, depends on the market that you're in.
And for tax planning, like that example, if you like, that using averages and medians or AVMs and so on is not going to give the investor the best result from a tax perspective.
No, it's not. And you can't rely on it, but it is a really important tool to give high-level trends, market directions, places to look. But then you need to dig a layer deeper, at least, to understand when you do go through as a valuer, you go through different properties, you speak to agents and owners, investors all day.
Yeah.
You get to see it for yourself and you get to almost analyze from street to street, property to property, it changes. So and then you get back and you compare it to the data and say, okay, well, the data's saying 8% increase over here. This one's a 25% increase and this one's 5% down, all in the same suburb and all in the same market. So it doesn't always line up like that.
So you can only really get that from the local expert.
Absolutely. Yeah.
Michael, if we reflect on the scale of Opteon for a second, we cover 98% of Australia's postcodes. We're in pretty much all of the markets around Australia in regards to the residential sector, the commercial, agri, specialist real estates. We do work for many customer segments, obviously lenders in the banking segment, but of course governments and consumers and for accountancy firms and lawyers and so on. So lots of different work. What are you seeing in some of those client segments, more recently post this change?
Yeah, so there's been some definite trends with some of them. Frankly, mortgage volumes, which means refinances, purchases, and so forth, it's actually in two things. It's refinance and it's purchases, right? Come back significantly in most metro markets. They come back 10, 20+%. Different markets are slightly different. The East Coast is more impacted in those metro markets. Regional, holding pretty steady with volumes, if anything, increasing and continuing to grow, maybe slightly less aggressively as they were. But one thing that we've noticed is from what we call non-mortgage in the residential space, and that is pre-sale advice, pre-purchase advice, financial reporting requests. And our clients are just wanting to have conversations. Our inquiries have gone up 80% since the 12th of May, 80+%, including the valuation work we do, the advisory reporting and so forth. So people kind of want to know, where do I stand within these markets? What advice can we give them in relation to that? So that they, like we said before, so they can set themselves up and make the right decisions structurally and property-wise.
So you've touched on a very important point there at the end in regards to people understanding I guess, what their asset might be worth because they're not sure whether to hold or sell or continue to rent it or occupy. We know that there's the date in the 1st of July, 2027, where because of the change of tax system, people will need to get an assessment done on their property. So that's one date where we would say, obviously, people should get a valuation because of all the nuances we've talked about in the market today.
They're going to have to if they've made a gain. Yeah.
Great. So just pressing it a bit further to your answer, why exactly would we advise people to get one now?
To understand what their asset's worth, what the market is doing in that location. If it's like we said, with some of the examples we've used today, if you're in an investor-driven market and all of a sudden investors are no longer in that market, so to speak, buying, if you like, then all of a sudden you've got a problem and you've got to solve it and you've got to figure out how to do that. So first, understand, where you're at, what the problem is, and then we can work towards how you're going to manage that.
It's a great point, Michael. The dynamics in some of the markets have shifted so quickly where segments of buyers have either decided to enter a market or exit the market within areas. So really knowing the dynamics of the market going forward so people can make a good decision is also really important.
Yeah. And so just because they're not building any new homes in some of these locations, that's not the only supply question we've got here. In investor markets, supply is when investors go to sell that property on the market. And if the demand is also being stripped out, that's where you can see some pretty significant drops, just as we've seen some pretty significant gains in some of those markets. Now, commercial's a different picture and probably a much hotter market at the moment, segment, if you like. But the capital gains tax rules apply to them just as much as they do for residential.
Very good point.
Yeah.
So there you have it, Mike. A bit of a recap from today. We spoke a lot about the micro markets. You certainly pressed on the point about understanding where you're at and getting a valuation, which I think is crucial. We heard a lot of examples from our valuers on the ground, which I thought was terrific. So thanks for joining us, and we look forward to seeing you again on the Budget Decoded.